from Lilu's investment in Lukoil, a deep dive into a value play. Part 3, Russia breaks, shock therapy, chaos, and forced sellers. So what exactly happened in Russia that caused this? To understand why Russia gave its economy away for free, you have to look at the streets of Moscow in 1992. The Soviet Union has just collapsed. The superpower is gone. The reality on the ground is apocalyptic. The supply chains are broken. The grocery store shelves are completely empty, and the government has just unleashed shock therapy, lifting price controls overnight. Inflation hits 2,500%. The reformers, led by Anatoly Chubais, are terrified. They believe they have a window of maybe 6 months before the Communist Party regroups, stages a coup, and drags the country back to the past. They have to dismantle the Soviet state economy. And they have to do it fast. The problem? The empty pockets. They want to privatize the factories, sell them to the people. But there is a massive problem. No one has any money. Decades of communism meant no private wealth. The hyperinflation of 1992 wiped out whatever savings people had left. You can't sell a factory to a population with zero cash. If they auction the factories for real money, the only buyers will be the mafia or foreign investors. Both options would start a civil war. The solution? The voucher. So, the government invents a new currency. They print 144 million vouchers, one for every man, woman, and child in Russia. The deal is simple. You take this voucher to an auction, and you trade it for shares in a company. You become a stakeholder in capitalism. The goal isn't fairness. The goal isn't to get a good price for the assets. The goal is irreversibility. They need to create 144 million private owners overnight so that the communists can never take the property back. The vodka valuation. This is where the plan meets the brutal reality of poverty. The government hands a voucher with a face value of 10,000 rubles to a grandmother in Siberia. To the government, that voucher represents a share of a nickel mine or an oil rig. But to the grandmother, it's just a piece of paper. She doesn't know what a dividend is. She doesn't know what equity is. She knows she is hungry. She knows her grandson needs shoes. She walks out of the bank, and standing right there on the corner is a man with a sign. He isn't offering stock advice. He's offering cash, or a bottle of vodka, or a bag of sugar. This created a machine designed to misprice assets. The desperate population sold their vouchers on the street for the price of survival, maybe $10 or $20 USD. The savvy operators, the future oligarchs, the red directors, and the hustlers bought them by the thousands. They bought the voucher for the price of a bottle of vodka, and they used it to buy shares in companies that were worth millions. So, Russia doesn't slowly reform. It snaps. Early 90s, the Soviet Union collapses, and what replaces it isn't a market, it's a vacuum. Overnight, price controls disappear. Subsidies vanish. Money stops meaning what people thought it meant. Inflation explodes. Not 5%, not 20, thousands. Prices don't rise, they detonate. Savings built over entire lifetimes vanish in months. Salaries trail reality by weeks, sometimes days. Pensioners are wiped out. Nobody trusts numbers anymore because numbers don't sit still long enough to mean anything. This is what shock therapy actually looks like on the ground. After the Soviet Union collapses in 1991, Russia tries to jump straight into capitalism with no transition and no institutional scaffolding. The state distributes vouchers to nearly every citizen in 1992-1993 paper certificates, nominally worth 10,000 rubles each. In theory, these vouchers represent ownership in the country's industrial core: oil, gas, metals, factories. In practice, almost no one understands what they own. Hyperinflation peaks above 2,500% in 1992. Cash today buys food. Cash next week is meaningless. So people sell. Not because they've done analysis, because they're trying to survive. Vouchers get exchanged for vodka, groceries, bus fare, $10, $20, sometimes less. There is no real stock exchange yet. No screens, no liquidity, no trust. Trading happens over the counter, informally, often on the street. Physical certificates change hands in chaos. Underneath all of this, the assets are very real. Oil fields, pipelines, refineries. Lukoil, formed in 1991 from three major Soviet oil entities and corporatized in 1993, rapidly becomes one of the largest integrated oil companies in Russia. The reserves are not a mystery. Soviet-era geological surveys are detailed and reliable for proven fields. Global oil prices are observable, roughly $15 to $20 per barrel through the early to mid-1990s. International press covers the privatization process in real time. None of the core facts are hidden. What's broken is the price. Russian oil reserves are trading at 10 to 20 cents per barrel, sometimes as low as 5 cents in moments of panic. In global markets, comparable reserves trade closer to $5 to $7 per barrel, even without assigning value to future exploration, production growth, or refining margins. On balance sheet terms, shares acquired through vouchers or early OTC trading imply valuations of half a cent to 1 cent per dollar of asset value, roughly a 99% discount to intrinsic worth if you value only proven reserves and ignore everything else. Li Lu later describes this gap bluntly. "I paid 1 cent on the dollar," he says. In another talk, he adds, "It was ridiculous. I thought at that point that's some kind of a margin of safety, even considering the political situation in Russia." He doesn't observe this from afar. He goes there, mid-1990s Russia. He travels in person to participate in voucher auctions and to buy shares of Lukoil directly. There is no passive execution here. As he explains, you had to buy the physical certificates from their holders. There was no stock exchange to speak of at the time. This means handling paper, navigating unreliable intermediaries, accepting illiquidity, legal ambiguity, and real political risk. But the arithmetic overwhelms the uncertainty. From publicly available reserve data, observable oil prices, and reported voucher trading prices, the conclusion is inescapable. Even if half the story is wrong, the downside is limited. As Li Lu puts it, the discount was so absurd that even if something went terribly wrong, you still had protection. He isn't forecasting reform. He isn't betting on stability. He's buying assets so cheaply that disaster is already priced in. Then, disaster actually arrives. In 1998, Russia defaults on its debt. The ruble collapses by roughly 90%. It's a financial catastrophe. Many investors are wiped out entirely. And yet, Li Lu points out a fact that still sounds implausible. Those who bought the certificates 5 years earlier were still up tenfold on their investment. After a sovereign default, after a currency collapse, early buyers at 0.5 to 1% of value are still sitting on gains of roughly 10x in dollar terms. That experience crystallizes the lessons. First, margin of safety is not theoretical. It's survival. Buying at a 99% discount buffers you against outcomes that would otherwise be fatal. As Li Lu later emphasizes, if you buy something at 1 cent on the dollar, the world has to end for you to lose permanently. Second, independent thinking matters most when markets feel uninvestable. Locals view the shares as worthless burdens. Western investors dismiss the opportunity as too risky. Li Lu trusts arithmetic over sentiment. The market wasn't inefficient, he later reflects. It basically didn't exist. Third, information and diligence create edge. He's willing to travel, to gather primary information, to understand assets on the ground. He later summarizes this principle simply. You need accurate and complete information. That's where advantage comes from. Fourth, time favors value when price and reality are violently disconnected. He isn't deterred by volatility or illiquidity. He's investing in the eventual weighing of assets, not the current panic. As he frames it, in the short run, markets are emotional. In the long run, they reflect reality. In hindsight, the Lukoil investment becomes a masterclass in value investing under extreme conditions. It isn't about predicting Russia's future or trusting political outcomes. It's about recognizing when fear has severed price from fundamentals and acting with discipline. Li Lu later describes this period as formative, not because it was unique, but because it proved something timeless. When prices detach completely from reality, you don't need optimism. You just need courage and math. That lesson carries forward, from Russia to later investments across Asia, and eventually to companies like BYD. He learns where to fish, in markets saturated with fear, friction, and misunderstanding. Places where $1 can still be bought for 1 cent, if you're willing to stay rational when everyone else panics. The theory says, free prices will create efficient markets. Reality says people panic. Factories keep running, oil keeps pumping, electricity keeps flowing, but the social contract breaks. And when that happens, people don't behave like rational economic agents. They behave like survivors. The government under Boris Yeltsin decides speed matters more than precision. They want to make capitalism irreversible, so they push privatization through fast, before the political window closes. And this is where the forced selling begins. Every citizen is handed a voucher. In theory, it's ownership, a claim on the future productivity of the country. In practice, it's abstract, confusing, and useless in the present moment. If you're trying to buy food this week, a future claim on an oil company doesn't help you. So people sell. Not because they've analyzed value, not because they've discounted cash flows, because they need cash now. This is the soil the Lukoil trade grows out of. Not brilliance, not prediction, but forced selling on a national scale. This is Avi. Like and subscribe. On to the next.